Hey, good morning, options traders, and happy Friday to everyone. And I received an email from one of our traders asking about a specific use of a short calendar spread. And he said, I've heard that it's sometimes called a poor man's straddle. And I've got this stock that I think is going to either make a big move up or a big move down. Is a short calendar spread a good way to approach this as a strategy? Well, first of all, remember that there's no reason at all for putting on a strategy or a trade if there's no, at least an apparent edge. If it's a strategy that's priced at fair value, there's no reason to do it. It's not really a bad trade, but it's not a good trade. There's no reason to do it. And so remember that the market doesn't care what you think. You can think all day long that the stock's going to make a big move up or a big move down, and it just doesn't matter. The question is, do we have an edge in our favor? So the better question is, how do you figure out if there's an edge, or at least an apparent edge, in a short calendar spread? Well, let's dig a little deeper and go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with a review of at least many types of spreads, because these names often confuse traders. What's a calendar spread? Why is it called a calendar spread? Well, a lot of these spreads are named after the way that they're laid out in your broker's platform. So, for example, we typically get the months, the expiration months across the top, and we get the strikes down the side. So let's say that you buy March 100 call, and then you also sell a January 100 call. Notice that you are operating horizontally. What you are spreading off or changing are months of the year. You're keeping the strike the same, but you're buying and selling different months. And because you're operating horizontally, this is sometimes called a horizontal spread and also called a time spread, because that's what the months of calendars are measuring, time. So this is also a time spread. Now you could also maybe buy the January 100 call and sell the January 110. And now you're operating vertically. And this is a vertical spread. It's also sometimes called a price spread because you are separating or spreading off prices. And then finally, if we go off in this direction, maybe buying the March 100 and selling the January 110, it is a diagonal spread. So another reason for understanding calendars is not just for trading calendars by themselves, but if you are trading diagonal spreads, which is a really popular strategy among traders. Because a diagonal spread is mathematically, and we've talked about this in previous videos, the same thing as buying the calendar spread and then buying the vertical spread. So think of this price down here, this January 110, as an address. We're looking at a city block. You could walk this way, and then you could walk this way and land down here. But you can also go from here and walk this way diagonally. And so mathematically, they are all linked. So if you are trading a diagonal spread, you are implicitly also trading a calendar spread and a vertical spread. And if for some reason there's an edge against you in this calendar spread, there's no reason to do the diagonal spread. You might as well just do the vertical spread. So that's another subtle reason for understanding calendar spreads. So the calendar spread specifically is you are going to buy a longer dated call or a longer dated put, and you will sell a shorter dated call or a put. That's assuming that we are talking about a long calendar, one that you've purchased. So notice that you have to use either both calls or both puts. You're buying the longer dated, selling the shorter dated. They have to have the same strike for the reasons we just saw on the previous screen. So for example, let's say that you buy a 120-day $100 call and sell a 30-day $100 call. That is a long calendar spread. And your risk graph is going to look something like this, at least at expiration of the shorter term option. So remember, whenever we're looking at calendar spreads or any risk graph where we have different expirations, when we see our risk graph, it's at the expiration date of the shorter term option. So that's why we don't get nice straight lines through here like we do in most of our other risk graphs, where we either have delta 1 or delta negative 1. And that's because these haven't expired yet. We're just at the expiration of the short. So we have a kind of a neutral strategy here. We'd like to see the prices stay somewhere near the strikes. And we have limited losses out here to the left and limited losses way up here to the right. So that's a long calendar. So the short calendar is just the trader on the opposite side of the long calendar. So once you understand what a long calendar is, just flip it. You're going to buy the shorter dated call or put, and you will sell the longer dated call or put. And so, for instance, you might buy the 30-day $100 call. Let's put some prices on it. Let's say it's trading for $229 according to a pricing model, and sell the 120-day call, $100 strike, priced at $457. So that would give you a $228 credit. And because you are selling the longer dated option, and because it's a credit, that shows that it's a sale. It's a short position. So this would be a short calendar spread. And again, this is why it's sometimes called a poor man's straddle. Because remember, all you're doing is you're looking at the risk graph from the opposite side. You're just the trader on the opposite side. So remember, this was our risk graph for the long calendar spread. So I've talked about this in a previous video, that if you want to visualize using calls or puts, you can flip this left and right. But if you want to visualize going long or short, you flip it from top to bottom. So just think if this were a piece of paper, you've got one hand at the top, one at the bottom, you're just going to flip it. And that would be the trader on the other side. So the short calendar is going to look like this, just on the opposite side of the trade. This person now is going to take a loss if the stock is here at the center, but can make a gain in either direction. And that's why it's called a poor man's straddle, because in a sense it does behave a lot like a straddle in the sense that you can make money if the stock rises or falls. But where it's different from the straddle is we eventually flatten out. We can't make an unlimited amount like we can with a straddle. So when you first put on a calendar spread, it's going to look something like this. It's going to be a lot smoother. And then over time, it's going to start moving down here in the center. Wings will start moving up a little bit. And then once we get to the expiration of the short, then we go to that. We get that nice hard V down here. That's how you can tell that you're at the expiration of the shorter dated option. So this is the risk graph at the expiration of the shorter dated option for a short calendar spread. Now we also have some break evens here that are a bit wider than you would expect. And again, that's because these deltas aren't 1 and negative 1. They're less. So they take longer to get out to that break even. So think if they were only delta of 10 or something really low, you could see that they would be very shallow. They'd be coming out this way and your break evens would be way out here. If you had a straddle where you would have delta 1 or negative 1, your break evens would be inside of this. So that's a trade-off for making it cheaper. So again, there's always trade-offs. You have to understand these trade-offs, and one is that your break-even points are going to be even wider than they will with a straddle, all things being equal. So let's talk a little bit more about the trading edge. Remember, if there's no apparent edge, there's no reason to do the trade. Now, why do I say apparent? That's kind of a funny word to put in there. Well, it's not the same edge as if you're talking about, let's say, roulette, where we can mathematically say the casino will absolutely win in the long run. That's an absolute edge. That's a mathematically proven one. This one might appear to be an edge, but there might be a really good reason why it appears to be mispriced that we just don't know about. But again, at least we could make some justification by saying, well, in my view, it seems to be a good deal because of this apparent edge. So that has to be there at a minimum before you even place the trade. So remember, as an analogy, I know that kind of seems like a hard concept, but think about this. You might think that your football team will win. Well, remember, when it comes to betting, nobody cares what you think. If you go to place your bet and you find that there's a 21-point spread against your team, it's not a good bet. So this is a real easy example to follow. I think my team will win, In fact, I'm highly confident they will win. Well, why didn't you place a bet? Because there was a huge edge against them. I just didn't think that they were going to beat this 21-point spread. That's exactly how you have to approach options. It's not what you think that matters. Is there an apparent edge? Okay, so now that you understand the concept, the best question is, where are the edges found in calendar spreads? Well, for this, we have to go back to our old friend, the square root pricing for options. So always remember that options are priced according to the square root of time. And what this means is that if you double the time to expiration, the options price increases not by twofold, but by the square root of 2, which is about 1.41, so only by about 41%. So the square root rule says that it takes about 4 times the amount of time to actually double an option's price. And that's because the square root of 4 is 2. So we need 4 times the amount of time before you're going to see that option's price double. Now this principle here applies to at-the-money options only. And the reason for this kind of odd square root relationship is that option prices are proportional to volatility, and volatility is proportional to the square root of time. So what exactly does this mean? Well, if we have a 1-month option trading for $1, what's the 4-month option worth? And this is what you need to go through to figure out if you have an edge, or at least an apparent one, in your calendar spreads. We're going to say how much time, what's the factor going from the first option to the second? Well, there's 4 times the amount of time. We take the square root of 4, and it comes up to 2. So I'm assuming that this second option, this 4-month option here, will be twice the price of the first one. Not 4 times, twice. So because this first one here is priced at $1, this second one should be priced 2 times higher. So I would expect it to be trading for $2. And if it is, it's not a great trade, it's not a bad trade, whether you're the long or short calendar. It's just fairly priced. There's no real reason to take the trade. If this first option is trading for $3, 2 times that would be 6. The 4-month option should be trading for about 6. All right, let's try one more. Let's say we have a 3-month option trading for 5. What would you expect the 27-month option to be trading for? Go through the same set of motions here. How much time is there between 3 months and 27 months? Well, there's 9 times the amount of time. Just 27 divided by 3 is 9. What's the square root of 9? Is 3. And there's our answer. We know that the second option should be 3 times the amount of price or the value of the 3-month, not 9 times. So because this one's trading at 5, we know that the 27-month should be trading for 3 times that, or $15. And again, if you saw this in an actual market, there's no reason to take the long calendar, no reason to take the short calendar. It's just fairly priced. But that's not always going to be the case. We do get skews and tilts in the markets, and that's where calendar spreads can come into play. So let's say that we see this. We have a 1-month option trading for 5, and we want to do a calendar spread. We want to buy a 3-month option and sell a 1-month. Well, is this a good idea? Is it a good trade? Well, let's go through the basic analysis. Again, we know that there's 3 times the amount of time on the second option, just 3 months divided by 1 month. We take the square root of 3, comes up to 1.73. So this 3-month option should be priced 1.73 times higher than this one, at about $8.66. And if it is, at least plus or minus a few pennies, and after accounting for commissions, there's no real edge in this position. There's no reason to do the long, no reason to do the short. It's just guessing. But now let's say that the 3-month option is trading for a lot less. It's perhaps at $7.50. Now this is where it becomes interesting. Is this option cheap or is this option expensive? See, we don't really know, but we do know that relative to each other, that the 3-month is relatively cheaper. Now remember, these are the same strikes, so we know that a 3-month option has to be worth more money. But relative to the square root pricing rule, it's actually cheaper. So in this case, maybe we have an earnings report coming out in this first month here, and we've got some kind of a big skew or a tilt going on here that's making this relatively expensive. So in this case, what do you know? Well, relatively speaking, the 3-month is cheaper, so the basic idea is buy the cheap one, sell the expensive one. You would want to buy the 3-month, and you would want to sell the 1-month. This would be a reason for doing a long calendar. You're buying the longer dated, selling the shorter dated. And that's because, relatively speaking, the 3-month is cheaper. Now, what if we saw something different? What if we saw this 3-month trading for $9.50? We said it should be about $8.66. What do we know now? Well, now we know that relative to the 1-month, it's more expensive. But be very careful about that. When I say relative, it's about this square root pricing. We know for sure the 3-month option will be trading for a higher value than the 1-month, but that doesn't mean it's expensive. It has to be more expensive than we would expect. So we calculated it should be about $8.66, and it's $9.50. So now this would be a case for saying, well, let's buy the relatively cheap one and sell the relatively expensive one. This is a case for a short calendar. Now, of course, we always have to be careful. There might be a reason why the 3-month is far more expensive. Maybe the earnings report is coming in out here. We have to also check the news and see if there's a reason that this might make sense. But at least you could make an argument for saying, I think it's still overpriced relative to the 1-month, and that would be a reason for doing a short calendar spread. So why use a short calendar? Well, you don't do it just because you think the stock might make a big move up or down. We have to see if there's an edge. And the edge is if the longer dated option is relatively more expensive than the shorter dated option. Relatively being the key word, relative to this square root pricing rule. So remember, the longer dated option will always be more expensive. So don't be shocked when you say, hey, the longer dated option is more expensive. It will always be. We have to see if it's relatively more expensive according to this square root pricing relationship. So remember, when we say relatively more expensive, that means only if it's more expensive than the square root pricing says it should be. But the final caveat and reminder, be careful of earnings or other news events. There might be a very good reason why these prices appear to be out of line. So when it comes to short calendar spreads, make sure you're at least checking this relative pricing as a reason for placing the trade, not because of what you think is going to happen to the stock. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.